A common question I get, especially when people are going from W-2, where they're used to having their taxes withheld, to a self-employed situation is, do I have to make estimates, and what do I have to pay if I do? So there's a rule, and it depends on your income, but the first rule is 100% of the prior year taxes or 90% of the current year taxes, whichever is lower. Now, if you have adjusted gross income of 150,000 or higher, it changes to 110% of the prior. So you want to make sure whatever your tax liability was, say you owe 25,000 in taxes last year for 2024, then 2025, you'd want to have at least 27,500 paid in. And if you are, say you're married and your spouse still has a W-2 that's got withholdings, you'll take that into consideration. So if half of it is being withheld, then the other half of that you would just need to pay in through the quarterly estimated tax payments, and those can be made online or you can mail a voucher. But I do recommend making those online and printing off the confirmation and then ensuring that they clear your bank account and keeping support for that just in case there's any issues, because I have seen where they haven't cleared. I've seen them get misapplied, and yeah, I often see when they're mailed that they're not cashed. So it happens a lot where they get lost in the mail. So I definitely recommend making those online when you can and keeping all of the support for those payments for when it's tax time. I also wanted to mention, what if you plan on your income increasing dramatically? Well, it's the lower of, so if you made the 110% of the prior year, for example, you could still owe, but you won't have that estimated tax penalty. So you'll just pay whatever the difference is that you still owe during tax time when you file your tax returns. And I would recommend, if you're not working with a CPA, to look at your income and do tax projections on a quarterly basis. Then I usually say 30% to be safe, to be setting aside into a tax account so that you have that money set aside come tax time when the bill is due. And that's depending on how much you make. If you push more of your income into a higher tax bracket, that might not cover it. And then if you're in a lower tax bracket, that might be overkill. So it would be advisable to work with someone to do quarterly tax estimates for you so that you're paying in the right amount and setting aside the right amount. But 30% is usually a good safe harbor starting point that I would recommend. It's better than nothing. And if you have extra money at the end, you can either keep it in there for the next year, or you've got yourself a nice little extra bonus.